we're at that point in the market where all the boards of these private companies refuse to budge on valuation.
In his most recent podcast, Chamath Palihapitiya discussed the big tech starts making cuts and what this means for the broader economy and startups. Chamath shares his thoughts about global debt numbers, Fed incompetency, and more. Before listening to him, please ensure to smash the like button and subscribe to the channel. Let's dive into his last interview now.
If you really think about it, if I had said 13 months ago that we would be sitting here today and the Fed would have hiked, 500 basis points in 9 months, plus or minus, you would have thought it was crazy. So we're sort of like coming into this phase of sobriety, trying to figure out how do we all do our jobs differently, and what does it mean for the investments that we've already put in the ground? And for me personally, I think the setup is that it amplifies tail risk. And so right now, I'm sort of somewhat quite cautious because I think there's a left tail risk, and I think Mike Wilson is here, but if you listen to Mike, who's been really right so far, the risk is that the S&P earnings are sort of with a one handle, 180, 185, and all of a sudden the S&P is, 3,200, 3,300. But then there's this right tail risk, which is that the Fed becomes dovish, everybody capitulates because it looks like things are slowing down. And now all of a sudden, though, you will have to deal with terminal rates that are going to be 4 to 5% on a more consistent basis, because if he lets off the gas now, then inflation kind of sticks around.
Yeah.
So both roads lead to repriced assets, just in very different path dependency. And those risks to me are a little heightened. And so I've tried to kind of be quite conservative and just, be down the fairway. A high rate environment, at least in the area in which I operate, which is, technology businesses, we've actually counterintuitively built better businesses during periods of high rates. And the reason is because there are fewer allocators that come to our part of the market because you can find better risk-free rates, as you said, the 2-year, even down to T-bills and repo, quite honestly. So that's one thing. And then the second thing is that in the absence of this surfeit of capital, it forces each individual company to frankly just be better managed because there's less money. And so we become, as an ecosystem, more intolerant of excess. And all of that just creates better run businesses. And so we haven't had that cycle for probably 14 or 15 years. And so we desperately need it, because if you look inside of a lot of technology companies, they're unfortunately rotting from the inside out, right? They've had a period where they've been able to raise successive amounts of capital to fund a valuation creep that frankly won't translate into what the actual money is you're going to get back. In our industry, there's a couple of dirty little secrets, or like the dirty soft underbelly. One of them is that only 10% of all of the firms in our asset class actually generate real returns. 10%, which means 90% are basically floundering around burning money. The other thing is that we have always consistently generated a high single-digit DPI, so like 1.7x is like the 30-year average on distributions. Yet we are the worst offender when it comes to showing people, like you guys, paper markups or TVPI. So there is this dance that this industry has been able to play because rates have been at zero. So as investors, the asset class, I think, is very challenged in order to generate real returns now. The companies that we funded have, as a result of all this excess capital, been more poorly run than otherwise. And so we need to course correct. So we need these rates to be sustained for 5, 6, 7 years, frankly, hopefully, in order to really flush it through the system. There was none. And the reason is that in that time, the narrative was that China was turning over. Mm-hmm. And so people needed to reestablish some amount of baseline global growth. And so they thought if China turns over and the US now all of a sudden raises too much, we're going to be in a lot of headwinds. And so Powell capitulated, but it turned out that China actually faded that perceived theoretical recession risk. And so all of a sudden the floodgates opened because rates were low here. You couldn't find any real growth anywhere. And we were at that period of the market where so many people had been sitting on the sidelines and effectively on the outside looking in, that they ran into the riskiest assets. So, technology ripped, crypto ripped, SPACs ripped. Everything that was on the far edges of the risk curve were really well bid to a point that now looking back clearly was unsustainable. But it's explainable in the sense that we gave folks no real other recourse because they were in the 8th or 9th year of no returns anywhere else. In our history from founding, we've had these things where we've had these major themes that we've always invested in, which is early stage venture, largely in healthcare and software and deep tech. And so that's been a consistent theme, and recently energy transition. That's been our bread and butter. But every few years, it has turned out that we sometimes go a little off-piste. And in the early 2011, I went off-piste and I made a huge bet in Bitcoin when it was $80 a coin. It just seemed like just an unbelievably massive risk reward. We did the same thing in the mid-2000s. We did it in SaaS. We did it in deep tech. And SPACs, we stumbled into this thing because we wanted to raise money for a bunch of our companies that were extremely capital intensive. And we demonstrated something that in a moment just caught a lot of wind. So yeah, as you mentioned, we did 6 of them. I think there were 650 of them just in 2021. So we're, about 1% of the market. I think we bought good companies well. I think we sold well, quite honestly. But it's one of these things where it was fueled by a moment in time of just enormous excess liquidity. And now I think we're sort of back to basics. So for us as an institution, we're kind of back to early stage venture. Who knows, we may go off-piste at some point to really try to ton it. That's our job as investors, right? Is like we allocate risk well, we maintain top quartile returns, but when there's a window, I'm the largest LP in my fund, so when there's a window, I go for it. And that was a moment where we tried to go for it. And just to give you some anecdotal data, like at the end of last year, I looked at 7 converts. And these were all extremely well-known companies that all of you would know on a first-name basis. And they all came to me trying to raise convert. And I said, well, here's the real market clearing price of these companies, and none of them took my money. And instead, they did a convert to basically deflect and kick the can down the road on valuation. So we're at that point in the market where all the boards of these private companies refuse to budge on valuation. And the reason is because it impacts meaningfully their DPI or their TVPIs that they've given to LPs. And so it's a very difficult part of the private markets right now to invest in because you will not be allowed to do true price discovery because nobody wants to take the real hits. The best companies will do it. I mean, I think you saw today that Stripe may take a 50% down round. That's probably the best technology company in Silicon Valley proper being built right now. So they'll do it. Klarna did it. In fact, it's so interesting that it's all, the through line there is Sequoia, which is an extremely disciplined and incredible organization. So they're able to enforce that discipline. But other companies, other venture funds, they don't want to look at the TVPI decay. And so it's uninvestable, quite honestly. On the other end, early stage venture has always been where the real gross dollar profits are made. And if you overlay that with a rising rate environment and you regress that back 30 or 40 years, in fact, we did it looking back 60 years, the most incredible opportunities to make money are actually when rates are rising in early stage venture. That's just the historical artifact if you look at public companies in size. So, we said very explicitly, okay, no more growth. The default answer right now is going to be no, we're not going to touch it. But we're going to continue to sort of over-index into early stage and do as many good deals as we can see. And because in a moment like this, when your asset allocation goes upside down, the most important thing are who can generate DPI? Who actually gets money back into your pocket? Forget paper markups because they're kind of not really worth the paper that they're printed on. Where are the distributions so that my actual assets can be more right-sized? They are the ones that I think start this trend of bottoming. Because what will happen is you'll go to the organizations that have had the most consistent TVPIs with the most inconsistent DPIs and say, I can't work with you anymore because this is now just money bad. And when those folks leave the market, those companies now become more prone to get repriced accurately because that set of GPs will say, I need to return money. And that's where guys like us can step in with clean balance sheets and lots of money to go and say, okay, let's go and reprice these. I honestly think that's like 3 years away.
Yeah.
I thought it was going to be 3/4 away. You know, at first when we were thinking about like how much capital are we really going to be allocating over this next period, we cut it by 2/3 because we just didn't see the opportunities in the late stage anymore. How the information economy and as a result the economy itself is going to work. You know, right now today you can generate using solar and wind energy that's effectively approaching zero, and it's cheaper than nat gas. And it's not just at the residential level, but it's also at the baseload power generation level. And so as a totality, you have the ability for 100 million US homeowners to effectively displace 1,700 utilities and all of that monopolistic behavior and regulatory capture. And so if all of a sudden you have free, abundant energy that you can collect from the sky and store in your garage and direct anywhere you want, you all of a sudden have the ability to solve problems via brute force that before you couldn't because they were boundaries of energy. Separately, we have found a way to transition away, Moore's law, away from CPUs into these application-specific chipsets now that operate in a realm of machine learning and AI. And the cost of that is effectively going to zero because these reference designs now are so well understood, the software is so powerful now. And when you multiply these two things together, if you wanted to brute force, reverse engineer every single theoretical protein that binds to every other protein in your body, what was a multi-billion-dollar compute and energy problem is now effectively a few tens of millions of dollars. If you actually wanted an infrastructure that could actually detect in real time how to give true autonomous self-driving, make extremely complicated decisions, and stop on a dime, those were compute problems that you can now basically render costless. And so when those two things come together, it's one of these really transformational moments in our society where you can go after some very big problems that we didn't think were tractable before. And so I'm very excited about that intersection and finding companies that play on those themes. You know, when I was at Facebook, my team and I were probably the first folks that really commercialized machine learning in the wild. You know, when our first versions of Newsfeed and some other technologies that you guys probably interact with every day essentially was about using machines to guess and to guess better and better over time. So that's basically what this is, just on steroids. And you know, what ChatGPT shows you is just the amazing value in allowing computers to assist you in doing work. It's like a calculator replacing the abacus, replacing a pen and paper. What's important, though, is this Buffett quote. A friend of mine told me this yesterday, which I loved. He told this story about refrigeration, and the story he tells is that the people and the person that invented refrigeration made some money, but most of the money was made by Coca-Cola, who used refrigeration to build an empire. And I view these large language models as refrigeration. Will there be some money made in it? I think so. But the Coca-Cola has yet to be built. And those are the companies that are really going to monetize it. And in order to monetize it well, here's a basic thing about machine learning that's worth knowing, which is if you take 1,000 of the same inputs and give it to Facebook and Microsoft and Google and Amazon, they'll all come up with the same machine learning model. But if you have one extra thing, one little ingredient that all of those other companies don't have, your output can be markedly different. It's like giving 2 great chefs 3 ingredients, but you give the 3rd chef 1 extra one. That person has the ability to do something very special. So right now we are in the world where everybody is crawling the open web. We're going to move to a world where as everybody gets sophisticated enough, where when refrigeration is widely available, somebody's going to say, you know what, this site, I'm not going to allow anybody else to access. It's only me, only for my models. And those models will become better. And so we have to let that play out a little bit. And so it's going to be a little bit of a really interesting arms race. So the next wave of M&A, for example, could be companies like Google and Microsoft and Facebook looking at these companies saying, can they be viable inputs to my large language models or to my other machine learning and AI models. So you could see M&A activity that drives that differentiation before anything else.